Over the past 5 years, August has often been the month where we see most volatility in financial markets. You may recall last year it was the time when European yields pushed out quite markedly, and we saw some quite dramatic moves in stock markets. That was similarly the case back in 2007, because we passed the 5-year anniversary of the beginning of the financial crisis. But this month of August, or certainly this year, has proved to be quite the opposite, and we'll take a look at some charts to demonstrate how quiet it has proved to be during the course of August this month. The starting chart, though, of course, is the Footsie 100. And if I was to put up almost any stock market at the moment, the trends that we're seeing back up again towards the sort of year highs would be reflective across, as I say, across most markets, particularly in the US, where shares are nudging towards 4-year highs at the moment. So we've certainly seen a very strong rally, still built upon this optimism of further stimulus coming through. It's not just Europe, but it also includes the US, and it also includes China. So a lot of this is helping to push markets up to new highs. But let's just take a look at the volumes. This is quite a busy chart, but is reflecting of the volumes on the UK stock market index. And you can see here that we saw one day in particular this week where volumes were down at levels really last seen back in 1999. A lot of these sort of low prints that we do see, you'll note, come in December, and it's around Christmas, so those are typically low volume days. If you strip those out, then this is a mid-August date, and you can see how markedly that is below that. So it is a feature of this market that whilst it's rising, it is going up on incredibly low volume, so something we need to just be sensitive to. The other area referred to is volatility. This chart is shorter dated, but you can see that volatility has continued to decline, and we're now starting to push down again into quite low levels of volatility. And I think just the word of caution here is that when you combine low volatility with low volumes and higher moving markets, it will be only a matter of time before we start to see this sort of turn the other way. That doesn't necessarily mean that stock markets will fall on the back of that. Indeed, they could move on quite markedly, but we just need to be aware that a lot of the moves are being associated to incredibly low volumes at the moment. I want to sort of now just pick up on a few of the features that I've looked at for this week, and the starting point would relate to the UK economy, where the Bank of England published minutes to its last interest rate setting committee. And one feature that you can draw out of that is that they have really didn't discuss interest rates at all at that meeting. There has been some market noise about a further cut in interest rates. Certainly the Sonia chart has been indicating that we may see something by November, and indeed I suspect that it's not completely off the table, but Mervyn King keen to sort of play down that thought at this stage, and that was good enough to help sterling move higher. And you can see here that this top level at sterling at the moment, top end of the range. Now that's not necessarily great news for the economy of the UK. We had one other number published this week, which was the trade deficit number, and that came in at a record 4.3 billion. So we're certainly importing far more than we're able to export at the moment, and that feels to me like a number that continues to worsen over a period of time. I wrote an article on this in the Confidant magazine about 3 months ago, and it is a situation that I think will be becoming more and more important to the UK at the moment if they are going to regain competitiveness to be able to export, certainly outside of the Eurozone. So the Bank of England were quite explicit in the minutes at the moment, saying that sterling is now running about 5% above its average for 2011, and any further progress on sterling could be damaging for the economy. So we need to just keep an eye on that, because of course the US and indeed Europe at the moment, everyone's keen to try and sort of reduce the value of their currency to increase competitiveness. So there is a chase to the bottom, as we describe it. Also want to now just refer to a few market stories this week. CRH, which is a big building group, really the only point to mention here is that they were quite nervous about the US economy. We haven't seen that so much in comments from international groups. They've been quite happy with the US, less so with Europe. But CRH were really just painting a picture that they think that a lot of the first half growth that they saw, particularly in the US, was growth that was brought forward from the second half, and they're much more nervous about that for the second half. And that is certainly also true of the oil services industry. Amec as well, issuing a warning last week, saying that they thought a lot of the first half growth had been brought forward from the second half. So that caused a fall in Amec stock, and we saw a similar fall this week with rival Petrofac, who saw a fall in their shares. One other sector that has been moving very well of recent is the utility stocks, and we've also had the added sort of benefit of a bit of bid speculation coming into the sector. At the moment denied, but it's been good enough to keep this sector of the market moving ahead. Centrica has hit close to a 3-year high. We have a buy note out on Centrica at the moment, and that is a sector that is moving very well. It was United Utilities that had the speculative spike up. Indeed, that share price temporarily hit around about £8, but came back to 7.30. But you can see here that for what is often deemed a fairly dull sector, the shares have really been performing very well. And finally, I'm going to finish on Tesco. This week we heard that Tesco's sales growth was better than any of their competitors, at up around 5% like on like. So maybe Tesco's getting it right again. We had this huge profit warning in January, and of course during this period here we saw them sort of quietly getting on with rebuilding strategy under that new CEO, and it's now starting to build. We're seeing this sort of share price showing some real strength, and really cheered by those sales growth numbers. So Tesco's back, taking market share. And that's a stock that has woefully underperformed over the course of this year, and may well have quite a bit in front of it to go if the feeling is that the turnaround strategy is on track.